The PDT rule is probably the most frustrating rules of stock trading if you have a small account, but since it's a rule that every United States broker has to follow, it's something we have to be aware of. Now, the governing bodies who make and enforce the rules and regulations for stock trading state that traders with account values of less than $25,000 inside a margin account may not make more than 3 day trades in a 5 business day period. So what this is saying is that if you don't maintain over $25,000 in equity value inside your trading accounts, then you are going to be limited to only making 3 day trades per 5 business days. But if you have over $25,000 inside your trading account, then you can make unlimited amount of day trades. There is no restriction. Now let's define what a day trade is. A day trade is going to be when you buy a security and then sell it within the same day. So let's say it's Monday and we bought 100 shares of Facebook at 12 o'clock p.m. And then we sold those 100 shares of Facebook at 2 o'clock p.m. That is going to be one day trade because we bought and we sold the same stock within the same day. So if you have a margin account with a broker that is based inside the United States and you have less than $25,000, then you are only going to be able to do something like this 3 times out of 5 day periods. Now, let's say that we bought 100 shares of Facebook at 12 o'clock p.m. on Monday and then sold them at 10 o'clock a.m. on Tuesday. Is this going to be a day trade? No, because we bought on one day and then sold on a completely different day. This is what we call a swing trade or an overnight trade. And there is no limitation on how many times we can do this. You can make an unlimited amount of overnight trades. But when it comes to making day trades, you are restricted to only making 3 if you do not have $25,000. So why does this rule even exist? Well, in the late 1990s, day trading had become very popular. And lots of people were entering into the market, and it was very easy to make money because of the rise of the dot-com era. So people were getting in, and they were using borrowed funds to trade with. And that's exactly what a margin account is. When you open an account with a broker, you have 2 options to pick. When you open an account, you can do a margin account or you can do a cash account. And this rule only applies to a margin account. And what the margin account does is allow you to actually borrow funds. And this is what a lot of people were doing when they first came into the market. You have all these novice traders that really have no clue what they're doing, but they were basically getting lucky because of these stocks that made huge gains because of the dot-com era. But what happened was that bubble burst and people just lost their shirts. I mean, people lost everything. And not only did they lose all their savings, but now they're in debt to their broker from all of this money that they borrowed. So what the SEC did and other governing bodies, they said, hey, we got to prevent this from happening again. So they implemented this rule to help protect traders that don't really have that experience from major financial loss, because they don't want someone that doesn't really have that much experience to come in and then just start borrowing funds that they don't have to just trade until their heart's content. Because this stuff, stock trading, it does have a sense of a gambling effect to it, and it can be very addictive. And when you put that kind of power of unlimited trades inside a novice trader's toolkit, I guess, it really is a recipe for disaster. And I really want to stress here that unlimited trades is not going to make you more money. It's actually going to make you lose a lot of money. Because, the goal of trading or being a successful trader is staying patient, waiting for those A-quality setups. And to be honest, those A-quality setups only happen a few times a week. So a lot of people get frustrated about this rule, and I completely understand, but just know it really is there to protect you. And if you can learn how to trade around this PDT rule or trade while abiding it, then you're going to be a very well-developed trader once you get your account over $25,000 and not have to worry about this rule. But starting out, I personally think this PDT rule is very helpful. Okay, so what happens if you make more than 3-day trades within a 5-day period and you violate this rule? Well, it differs from broker to broker, but most of the time they will give you a first time warning. So if you break this rule, you can call them up and say, hey, I didn't know about this rule. Can you give me a warning? But they're only going to do this once. And, if you break it again, then you are going to be restricted from opening any new positions for 90 days. Now, you can close all your positions, but if you want to open a new position, say that you want to buy Facebook again, you're not going to be allowed to do that until the 90-day restriction period is up, or if you bring your account balance up to $25,000. All right, so it's really important to keep track of all your day trades so you don't end up freezing up your accounts and have to wait the 90 days, or end up having to change brokers so you can day trade again. So just keep track of your day trades. Now, there are ways to get around this rule. The first is, instead of using a margin account, you can contact your broker and ask them to open what is called a cash account. Now, cash accounts are exactly how they sound. There's no borrowed money. You only trade with the cash that you have. And inside a cash account, you can make unlimited day trades. But the drawback is you have to wait 2 days for the funds to settle each time you close a position to be able to use that money again to make another trade. Another way to get around the PDT rule is to use a broker that is located outside of the United States. Since these brokers are outside of the United States, they don't have to follow certain rules the governing bodies enforce. Some offshore brokers I would recommend would be SureTrader or CMEG. I think those are probably your best bets off of offshore brokers, but you have to understand that these are brokers outside the United States. You're going to be paying foreign taxes. Their fees could be a little bit higher, so I would really only use something like that if you already feel really comfortable with your strategy and you already have that experience day trading, and it's really only meant to just kind of hurry up and kind of grow a small account into a bigger account. But once you get over that $25,000, I would not use the offshore broker anymore and use a United States broker. And of course, the last thing is you could just swing trade. You can hold positions overnight and not have to worry about day trading at all. All right, so that is the PDT rule. Hope you learned something. Thank you so much for watching.